Welcome to The Explainer. Today, we are unpacking the fascinating first quarter 2026 earnings report of a true industry giant, the $2.8 billion footwear powerhouse, Caleres. Now, even if you don't immediately recognize the corporate name, I can almost guarantee you have a Caleres shoe sitting in your closet right now without even knowing it. They're basically the invisible engine behind some of the most recognizable footwear brands on the market today. If you follow the retail space at all, you know exactly how tricky the current consumer environment has been, right? Inflation, shifting trends, cautious spending, it's all battered plenty of legacy brands. But Caleres just dropped some quarterly numbers that are seriously turning heads, and we're going to break down the exact strategies they're using to completely defy the current retail gravity.
Here's our roadmap for today's Explainer. We're going to start with a look at their surprise Q1 earnings beat, then head inside the massive Caleres footprint. After that, we'll see how their brand portfolio is leading the way, dig into the famous footwear pivot, and finally, wrap up with their future outlook for 2026. Let's dive right in.
Starting with Section 1, a surprise Q1 earnings beat. Let's look at exactly how they outperformed expectations right out of the gate.
Okay, to put things into perspective, driving $667 million in first quarter sales is no small feat. That's an 8.5% bump from last year, and it actually hit the absolute top end of their corporate guidance. We really have to remember the broader context here, too. In a macroeconomic environment where discretionary spending is super tight, and honestly, a lot of legacy retailers are struggling just to keep their sales flat, posting an 8.5% top-line increase is a massive signal. It tells the market that consumers aren't just out there casually browsing, they are actively opening their wallets for these specific products. Hitting the top end of guidance is so rare right now, and it proves that something in their core strategy is just clicking in a very real way.
You can literally hear the internal momentum in this statement from President and CEO Jay Schmidt. Leadership is publicly celebrating the strength of their broad-based growth. But I want to zero in on one phrase he used: strategic growth vectors. What does he mean by that? Well, in the retail world, that's basically code for deliberate, calculated bets. This isn't just dumb luck or some sudden fleeting trend catching fire. They laid out a specific blueprint for their investors, targeting particular consumer demographics, investing in finely targeted sales channels, and this quarter proves those specific vectors are successfully pulling through to deliver high-end results.
Now, driving top-line sales volume is one thing, but converting those sales into bottom-line profitability, that's the true test of operational efficiency, especially when you factor in all this inflation and rising supply chain costs. Caleres reported an adjusted earnings per share of 38 cents, and not only does this comfortably beat the 22 cents they posted at this time last year, but it beat Wall Street consensus estimates and their own internal guidance. They're proving to the market that they absolutely do not have to sacrifice their profit margins just to move inventory. They can drive volume and profitability at the exact same time.
Which brings us to Section 2, inside the Caleres footprint. We are talking about a 150-year-old giant here.
Before we get any further into the heavy financials, we need to talk about the actual products driving these numbers. Because what makes Caleres so incredibly resilient is its strategy of intense diversification. They aren't just making one type of shoe for one type of person. Not at all. Their portfolio hits almost every conceivable consumer lifestyle. We're talking athletic sneakers, casual slip-ons, premium fashion heels, durable work boots, the whole shebang. In retail, this level of diversification is basically the ultimate armor. If consumer tastes suddenly pivot away from premium fashion and swing toward casual comfort, Caleres is protected because they own major brands in both categories. They just capture the consumer wherever their tastes happen to land.
To truly understand how they operate, you've got to grasp this massive global footprint. Let's look at the stats. Nearly 150 years of craftsmanship since 1878, 10,000 employees globally, operations in over 60 countries, and a staggering $2.8 billion in trailing 12-month revenue. But the most vital metric here is that last one. 67% of that revenue comes direct to consumer. In the retail industry, a high DTC percentage is essentially a superpower. It means Caleres isn't relying entirely on big department stores to sell their goods. By selling directly to the buyer, they capture vastly better profit margins. They maintain total control over how their brands are presented, and most importantly, they get direct, unfiltered access to invaluable customer purchasing data.
All right, on to Section 3, brand portfolio leads the way. Let's dig into the specific segment that's currently carrying the team.
So here we find the core narrative tension of this entire earnings report. It's basically a stark tale of two completely different segments. Their brand portfolio segment, which houses their owned brands, is absolutely soaring, posting a massive 20.6% growth in sales. Meanwhile, their famous footwear retail arm dipped by 2.5%.
This perfectly illustrates the macroeconomic divide happening right now. The aspirational shopper who is buying specific premium brands, they're still willing to spend heavily. But the budget-conscious everyday retail shopper visiting famous footwear, they're pulling back. And Caleres has to manage both of these realities at the exact same time.
Drilling down into the brand portfolio's massive wins, we see an incredible 21% jump in owned e-commerce sales. And let's unpack why that matters. Owned e-commerce means sales happening directly on their proprietary websites, not through third-party giants like Amazon or Zappos. Driving a 21% increase here is a huge win for customer retention. When a shopper buys directly from your site, you capture their email, you learn their exact sizing preferences, and you can market to them directly for their next pair of shoes. It literally builds a moat around the brand.
And their global reach is expanding just as aggressively, with international sales absolutely exploding by 70%. The data shows this surge was driven heavily by the undeniable strength of brands like Sam Edelman, which is clearly just resonating across international borders right now. When you combine owned e-commerce surging domestically with international sales rocketing abroad, you get this incredibly powerful compounding effect. It's exactly why the brand portfolio saw its operating margin jump up to an impressive 11%. They're selling more shoes, and they're doing it in the most profitable channels available. That takes us to Section 4, the famous footwear pivot. Let's look at how they are addressing the challenges on the retail side of the business.
Famous Footwear isn't just sitting still and accepting that 2.5% sales decline, they're executing a highly deliberate pivot. First, they are rolling out an elevate and edit strategy. In retail, this just means ruthlessly cutting the deadweight inventory and visually pushing high-margin premium products right to the front. This curation alone drove a 49% increase in elevated product sales. Second, they're deploying their new Flare store formats. These are newly remodeled, high-energy layouts designed to make the physical shopping experience way more engaging. And get this, these Flare stores are actually outperforming the rest of the traditional chain by 9 points. They are fundamentally changing how the customer interacts with the physical store. And third, they've maintained a fourth straight quarter of strong e-commerce growth.
And despite the overall segment taking a slight dip, these surgical, strategic moves are paying off in highly targeted areas. Specifically, Famous Footwear grabbed a 10% market share increase in kids' shoes within the shoe chains category. Think about why winning the kids' demographic is such a big deal. Kids are constantly outgrowing their shoes. It effectively creates a reliable, recurring revenue stream for the retailer. Even when the economy is super tight, parents still have to buy new shoes for their growing kids. Capturing that market share provides an incredibly stable foundation for them.
Finally, we arrive at Section 5, Future Outlook for 2026. Let's explore how leadership is setting expectations for the months ahead in what they're calling the Build Back Year.
I absolutely love the phrasing here. Calling 2026 a Build Back Year is just a classic piece of Wall Street psychology. It's a highly strategic way for leadership to lower the immediate bar while still promising long-term results. By using this exact term, the CEO is acknowledging, hey, there's still heavy lifting to do, particularly in turning around the Famous Footwear segment. But it frames all of these really strong Q1 metrics as the foundation for a much larger corporate comeback. They're effectively telling investors to be patient, setting expectations for modest sales, but promising highly meaningful earnings growth as their operational efficiencies fully kick into gear.
You can totally see that confidence mapped out in their official guidance. They're predicting mid to high single-digit sales growth for the second quarter. But the real standout metric here is the gross margin, which they expect to expand by 345 to 375 basis points next quarter. In plain English, that means they expect their profit margins to increase by roughly 3.5% to 3.75%. They attribute this directly to successful tariff mitigation efforts. Basically, by actively restructuring their supply chain to avoid international tariffs, they are keeping cash directly on their balance sheet. It proves they are managing their back-end costs every bit as aggressively as they are chasing new sales.
So, as we wrap up today's explainer, the ultimate takeaway here is that in the modern retail landscape, deep diversification is absolutely essential for survival. Caleres has nearly a century and a half of footwear dominance under its belt, and right now, they're orchestrating this incredibly delicate balancing act, leveraging their high-flying brand portfolio against a highly cautious consumer base at Famous Footwear. If Q1 is any indication at all, their build-back year is off to a phenomenal start. So, can a 150-year-old shoemaker teach modern retail a lesson in resilience? We're certainly going to find out. Thanks so much for exploring the numbers with me, and I highly encourage you to keep a close eye on these two fascinating segments as the rest of the year unfolds. Catch you next time.